we are privileged to have amongst us Mr. Sandeep Tandon, founder and CIO, Quant Group. Mr. Tandon has 3 decades of experience as a funds professional, and his Quant Group has a strong commitment to investor education and distributor knowledge partnership. He will tell his view with a presentation titled Dynamic Style of Money Management, Investment Mantra of the 21st Century. Over to you, Mr. Tandon. Welcome. Thank you.
Yeah, perfect. Very good morning, friends. So I like to thanks MapDAC for inviting us for a interesting session. Let me start with a different way, okay? Everybody wants to keep himself or herself relevant at all given point in time, okay? That's what everybody wants, but it's not easy. Age factor, various factors are there. So very limited people remains relevant all life. So coming from the investment point of view, it is our endeavor to remain relevant at all point in time. You know, we all know that we all live in a very dynamic world, and keeping us or maintaining this relevance is not easy task. So being relevant is also a philosophy, is also a title of the book which we have written in 2019. So it's a philosophy which we practice. For you guys, we could be a relatively new mutual fund. We are one of the youngest and the fastest growing mutual fund in the industry. But we acquired one of the oldest asset management company called Escorts. Way back in 2015, I took a strategic stake, and 2017 we acquired it. So that's the way the genesis of Quant Mutual Fund came into picture. So we have been managing that money for nearly 7 years since then. Okay. We started accepting public money somewhere in the month of August 2020 onwards when we came on NSE and BSE platform. We are completely asset-light model, predominantly present on digital platform. So from 180 odd crores, we have moved to 17,000 crores. We are close to 18,000 mark as of yesterday. And what is very interesting journey is that we have 20 lakhs folio, okay? So everything in Quant moved from a risk perspective. When 20 lakhs folio means we have very real retail customer, very sticky money. The concentration risk is far lower, and that's the way we define. So we have started looking at expanding the real retail base rather than just focusing on the institutional money or the family office money. Now, when we talk about Quant, we quantify everything. The name is not coming from the quantitative techniques or we run algo product or anything like that. It's about Quant, that we quantify everything live. And since we all live in the numbers world, I always talk about mathematically you have to decode everything. So there is no space for any subjectivity within Quant. So we talk about that objectivity is our religion and data is God. So a very mint-fresh approach toward data analytics. Quant Mutual Fund is all about data analytics, okay? There is no space for my views or your views. It has to be backed by data, and data drives everything, and that is something which I'm going to showcase in a few minutes. So when we talk about that we quantify A to Z of financial market through a predictive analytics model. So let me give you some perspective. We are not astrologer to predict anything in the markets. What exactly we do, if you recollect your kindergarten days, okay, in the drawing book, you have these dots which you connect and the picture gets emerges, okay? This is exactly what we do. When we connect the dots, some picture emerges. That is the strength of predictive analytics. The only difference is that we connect the dots for both from the macro perspective as the micro perspective. So we combine both dependent and independent variable and run a complex multivariance model where we get a perspective how the world looks in next few years, how the asset classes looks, how we talk about stock selection, asset selection, money flow analysis, all those things is a part of a predictive analytics. This is something which we want to talk about. So when we say quant, it means we quantify everything, including sentiments, okay? Anything which affects markets, we look at. It has been a fashion to talk about geopolitical volatility nowadays. It has been fashion to talk about climate change, weather conditions, okay? But nobody quantify what is the impact on the market. So we take it to the next level where we quantify how magnetic fields affects markets, how geopolitical calculation you can do reverse. If you can forecast the crude outlook, or gold outlook, or natural gas outlook, we can reverse calculate and say how the geopolitical volatility will move or not. That's something I will also demonstrate. So when we talk about in markets that we quantify everything, yes, you can quantify the earnings of a company. That is also assumption based. Can you quantify the valuation multiple? That's a big question. In the last 30 years, I have not seen a single report where anybody quantify the numbers. That is the biggest problem which we face in the industry when we talk about a valuation-based approach. Okay, when we talk about only valuation analytics, the biggest challenge is that it is dependent on the price element called a dependent variable called price, and when price changes, everything changes. Okay, and that is the biases we try to remove. I'll explain you in a VLRT framework. So a quant, we quantify fear and greed, we quantify whether it's a risk on risk of environment, what sort of global liquidity is prevailing, what sort of geopolitical volatility is there, and then try to connect the dots and form opinion from the risk management perspective. Okay, so we all live in a dynamic world, but then why our money management styles are very static? When we say money management styles are static, it's a unidirectional. And when you talk about unidirectional or one directional, we just focus on the pure valuation analytics. This was a point which I was trying to raise. The valuation analytics is a great tool, it's a backbone of every investor. It gives you a great entry point. But purely on the valuation analytics, it is very difficult to quantify the exit. And that's the way we brought the concept of dynamic style of money management, where we combine a lot of data points. And the whole thesis revolves around how well we can add alpha and reduce the beta. Basically, we add additional returns with limited risk. That's the point which we are talking about. When we say in a dynamic world we live, okay, we have to combine multiple data points. And then it gives you far, far superior picture. I will explain you some of things. Let's look at the conclusion or the outcome of dynamic style of money management, which we brought on the table. Okay. This is the performance of most of the schemes which we have managed right from March 2020. We have taken. Why March 2020? One reason it was on 23rd March we hit a lower circuit on the exchange. It's a one cycle, and that's the time around September 2019 and May 2020. That's the period where we implemented our VLRT framework. So it'll give you a very good perspective how the market how the schemes have performed. If you really look at, we are one of the few mutual funds. All the schemes are actually in the top quartile, okay? And look at the outperformance we have given small cap, nearly 321%, 477% return, the outperformance of 303%. So if you look at the outperformance part is pretty massive. What is more interesting, apart from the outperformance, what risk as a mutual fund we have taken? If you look at our Sortino ratio, Sharpe ratio, or the Genser alpha, clearly showcase that with limited risk, we generated extra alpha, okay? And alpha is very, very meaningful as compared to category average. It is not percentage, it is times. It is few times of Genser alpha the quant mutual fund schemes have generated. And that is the beauty of dynamic asset management, money management, when we talk about how dynamically we manage, and you can keep on accumulating the small alpha, which leads to a massive outperformance over a period of time. Okay. So when we talk about Quant as a mutual fund house, what unique we bring on the table? So we talk about how, see, people in the industry when raise money talk about certain IRR will give you, this is my track record, this is my experience. We all hear that. As a money manager, we do that. But we define it very differently. We say we are in the business of risk management, and returns are byproduct. If you can manage your risk properly, anyway you will generate alpha, okay? And that is a strength which it's a unique thing, because I used to manage one of the largest treasury in the country. We used to do like 5,000-6,000 crores of turnover on daily basis with 380 traders. We never had single quarter negative. We ran that product for 10 years and never had a single year negative. So that's to give you perspective from a risk understanding. We manage money like a treasury. Whole idea is not to lose the capital, even in the risk off environment. You have to protect the capital and generate extraordinary alpha when there's a risk on environment. So that extra alpha helps you in difficult times. So if you talk about, when we say the risk man, we're in the business of risk management, returns are byproduct. Let me explain you some of the data points. Okay. Risk mitigation through our framework called VLRT, when we're talking about, I will explain this concept in next few slides. Okay, it's a part of a strategy that we have to prune down our risk. If you really look at, as a house, we are very strong believer of timing. Okay, timing is everything in life. We have been taught nobody can time the market, timing is bad, timing is something which is very difficult. But I can demonstrate mathematically it is a part of risk management process, how well we time the market. Timing is about data analytics. Okay, when multiple data points are skewed on one side, it gives you better timing. This is something which we have demonstrated on continuous basis. If you really look at everybody sitting in this room, every investor, every money manager, every business house, every trader wants to time the market. We always talk about right place, right time. So timing is that essential. The challenge is we don't want to accept it, okay? Because we have been taught timing, nobody can do it, okay? And this is the part of our risk management process. Timing is very important. Let me give you a small example. In September 2021 or October 2021, when global markets peaked out and technology boom peaked out, we could be the only house in India who has talked about the technology sector has peaked out globally. There's a euphoria, okay? And we exited all the technology stocks of our portfolio. If you see our fact sheet in the month of October 2021, you will not find any technology names, okay? We sold technology and bought, just example sake, ITC and banking stocks. All else is history. By May, June, people realize, oh, that was the peak of the technology stock and the banking has rallied, ITC has rallied, okay? That is the importance of timing. So when we talk about our important tagline, we use the word multi-asset, multi-manager, okay? So we as a house strongly believe that all asset classes are interlinked, and if you can gauge that part very well, it gives you better research capability, it gives you better risk-adjusted returns, because you can gauge risk far superior, or you can gauge where the probability of returns are on the higher side. Everything what we do is on the mathematical side. So when we talk about multi-asset, multi-manager as a concept, so multi-manager is also important. So we are not dependent on one human being. That's the one aspect. We don't want to be dependent on one style of doing business, okay? So every scheme is managed by 3 managers. Somebody looks at the valuation analytics, somebody looks at risk appetite, somebody looks at the liquidity. And in turn, this can be further subdivided. So we believe in specialization. It is actually a myth when you people expect that one particular money manager is very smart, he knows extraordinary things. It's not possible. I have 20,000 deficiencies. If you expect that I can specialize in each and every area, then it's not possible. As a human being, it is not possible. And that's the way the strength of team come into picture. Team with specialists, not with one manager, okay? So it's a part of a risk mitigation we talk about. When we talk about multi-dimensional approach, this is another approach that we combine multiple asset classes, multiple style of doing businesses, or various type of research. When you talk about qualitative, quantitative, and behavior, that also reduces human biases. Because ultimately, financial market is all about fear and greed, whom we are dealing with, one animal called human beings, which have a greed and fear. The intensity of fear and greed differ from market to market. For emerging market, the intensity is on higher side. For the developed market, that intensity is the lower side. So when we talk about a multi-dimensional approach, it's another risk mitigation technique which we bring. Very important aspect when we're coming to the timing aspect. How can you time the market better? One approach is that you chase the momentum as price moves up, because we say the price is bhav bhagwan hai, okay? The price tells you something, okay? I will take it to the next level. What drives prices is the demand supply. What drives the demand supply is the perception what drives. What drives perception? Sentiment. Then you can drill down and on, okay? So what we are trying to showcase is that if you are able to identify the inflection points, extreme fear, extreme greed, extreme complacency, extreme panic, if you can quantify, like September 2021 was the extreme euphoria or greed element was the highest for the technology stocks, new age companies globally. And simultaneously, for the banking space, it was a neglected territory. ITC was the classic example I will take. it was completely in the neglected territory, most hated zone, okay? People used to talk about, used to send jokes about it. The fear element of ITC was very high. That was the peak of ESG as a phenomena. And we actually took a very contra call, though we like ESG as a concept. But from September 2021, we changed our portfolio style and we invested into anti-ESG thesis, okay, where you talk about capital good stocks or defensive stocks, okay, or liquor stock, or cigarettes. So the whole thesis, we reversed and we used that opportunity. That was the peak of the energy crisis globally, or rather the genesis of the energy crisis, okay. So when we talk about inflection points, as a house, we believe we are inflection point strategies. We don't chase momentum. We identify extreme points of the life, so you are ahead of the curve. You will be early in buying and you will be early in selling. Nobody can top the exact tops and nobody can capture the exact bottom. So if certain characteristics are visible, we try to capitalize on that. Other important aspect from a risk management perspective is that we keep on hearing in the markets, or we have been taught like that, we are long-term investors. I buy for longer term. Yes, as an investor, you should be long-term. Equity and asset class is long-term, but sector and stocks are not long-term. So when we say, oh, I hold this stock for 10 years, I'm a long-term investor, I hold this 20 years. If you go back in the Nifty or S&P, some of the groups which was there at the blue chip companies those days, they don't exist today, okay? So you look at in this room, apart from the gentlemen taking pictures, everybody has a mobile, okay? The Kodak become irrelevant, okay? That's the way pace technology is changing. So if you say I'm a long-term investor in Kodak, you could have wiped out your capital in that. That's the way we look at long-term as asset class. As an investor, you are long-term. Never get married with any stock or sector. That is the part of a risk management technique which we explain is not long-term. Another important aspect, we are completely unconstrained house. We are style agnostic, market cap agnostic, sector agnostic, thesis agnostic. We are not married with any view. We are pure opportunists. Wherever we see opportunity in the markets, which I get better risk-adjusted return, that is the opportunity which I'm willing to capitalize. So as an unconstrained house, that gives me highest level of flexibility and it actually reduces the risk, okay. When we talk about a dynamic style of money management, the environment changes. Let's say April 2020, which was the phase where global risk, post-COVID I'm talking about, the risk appetite just collapsed. If you recollect, we were all worried about life. There's no question of any investment at that stage. Everybody knew that was a great opportunity. Just see, maybe you can count on the finger, hardly one or two people could have invested on that day because that was a fear. So if you measure mathematically, the risk appetite for the Indian equities as well the global market was the lowest at that point in time. And after March, it was started improving. And liquidity was at lifetime high because third-party central bank after Lehman crisis, they were working in tandem, and because of this pandemic, they were also again working in tandem. So highest ever liquidity, lowest ever risk appetite is a lethal combination for a bull run. And that's the time we capitalize our opportunity. We deployed money by 15th April, we are fully deployed, and by mid-June or mid-May, we were shifted our large portfolio towards mid and small, which lasted till September 2000. So the massive outperformance which we built in that phase was through mid and small because the timing was right. Again, I'm bringing the concept, timing was right. Timing from data, timing from not gut feeling. Timing is not a trading technique in any manner. Timing is a risk mitigation. And this is what the data analytics were showing. Come 2021, we spotted extraordinary liquidity in the market. We spotted highest ever money flow towards global equity. And there was a euphoria. And if you dissect the euphoria was in new age companies, technology companies, growth companies, not in value. And the risk appetite started declining. We shifted our entire portfolio from growth to value, and that was the game changer. So it's not about doing a postmortem analysis, identifying those inflection points. Come June 2022, right from November 2021 till June 2022, it was a risk-off environment. Whole idea is to protect the capital at this point of time, okay? And 15th June, we came out another note talking about exhaustion in risk appetite, exhaustion in liquidity is changing, and reflects rally on the card, how beautifully it played out India. So this is the way Based on the risk of environment, we try to rebalance our portfolio, reconstruct our portfolio. That leads to higher churning because we have been taught churning is bad. Turnover ratios are high. This is all myth. In the mutual fund industry, the first paramount thing is how do I reduce my risk for my investors. If I'm able to gauge it is a risk on and risk off, it's a very tax efficient vehicle, I will capitalize that opportunity and rebalance my portfolio. Whether it leads to higher churn, doesn't matter. There is no concept like churn or turnover ratio in any portfolio management book. It's a concept of rebalancing. It is only in India we have built this unique concept, churning is bad. It is a rebalancing exercise, it reduces your risk. So this is another philosophy aspect. You have to change something which is there in your subconscious mind. A lot of people have linked these questions about the size. So we also talk about how size also helps you in generating alpha and reducing the risk. One of the session I talked about how corporate access gives you better risk adjusting opportunity, you have better access, you get blocks at discount. So it's all about how I can generate extra alpha with limited risk. So most of the funds are 5-star rated funds. Okay, let me skip. Last year we got the Lipper Award for equity as a house, a good achievement for a very young fund house. Okay. Few slides I want to showcase about just performance aspect. This is the value research annual edition. They cover more than 450 or 500 schemes. Okay. And if you really notice, out of top 6 SIP returns, 5 belongs to Quant. So that's the achievement of a 500 schemes, top 5 belongs to Quant from a very young house. So is the case with the most rewarding core fund. Out of top 10, 3 belong. This is a 10 years category. 3 belongs to Quant and top 2 belongs to Quant. And so is the tax plan one of the highest in 10 years category. So I just skip some of these things. I just want to bring some data points. Very interesting data points I want to talk about here. As you know that Quant runs a very asset-light model. It is more dependent on the market intermediate. Like we are pure manufacturer. We are just money manager and do research. Okay. Very interesting data from B30. Our contribution to our AUM is 24, which is the highest in the industry, which means we have reached at the masses level. And out of this 24%, 65% comes from people like you. Distributors have selling our product in Ludhiana or Jalandhar or smaller towns. That is the benefit, how the performance drive and attract investor. And that is our endeavor, how to deliver better, superior risk-adjusted returns. So I'll skip some of these lines. Let me spend few minutes on our VLRT framework. When we say timing is very important, how we mitigate the risk, okay? Before that, so we talked about how this qualitative, quantitative aspect is there. We say fundamental Atma, liquidity, the prana, and sentiments, the Maya. It's very important for us, okay? So, okay, what exactly we do? We run our own predictive analytics model. We have a large research and analytics team, and then we have money managers. All put together, we say analysis adds up. Okay. The whole idea is to keep producing specialists rather than having a journalist working for us. So we have a 21-member team. So multi-dimensional lead to multi-asset, multi-manager, and multi-variants model, which leads to a better outperformance. Now coming back to the VLRT framework, very interesting data points. We all keep on hearing the valuations are cheap or expensive. In 2020, after market rally, we heard a lot of things. Oh, it's a liquidity-driven rally, tsunami of liquidity. Market did very well. Come 2022, right from February, we are saying liquidity has dried up, central banks are tightening, sentiments are bad. We all know all these things. We all hear these things in media. But do we change our portfolio drastically? Answer is no, because we are long-term investor. Okay? That's the way we differ. We rebalance our portfolio in a dynamic manner. And that's the reason you see how these 4 elements work in motion. Some crack, some building blocks are cracking. We are rebalancing, readjusting our portfolio. It reduces the risk. And that is the strength of our VLRT framework. It's the risk mitigation technique which we bring on the table. And if I have to define now time is a function of valuation analytics, 1/3 weightage. Time is a function of liquidity analytics, 1/3 weightage. Time is a function of risk appetite, which is sentiment, 1/3 weightage. So we give 1/3 weightage each of the analytics. It gives me better timing, it gives me better risk management, it gives me superior risk-adjusted return. That is the way we operate our VLRT framework. And let me give you a small example look at the strength of predictive analytics, okay? A lot of people think, can you forecast what is coming in next decade or next many years? So this is something which I'm going to talk about. In August 2012, in those days, we used to run our advisory and broking business, and we have printed this slide in part of our strategy report. It was published in August 2012. Okay? Very interesting is that if you noticed, the red color is there is a geopolitical volatility is rising. Between 2020 till 2025, we are seeing what is coming. Highest ever interest rate, highest ever crude prices, highest ever wheat prices, not highest ever gold prices. All this trailer we have seen 6 months back. Okay, if you recollect May to July, that was the period globally it played out. This is just a trailer, big ugly picture of global deterioration is spending in maybe in few years later on. It's not happening immediate basis because everybody expect that time it never happens. So if you recollect to visualize a biological war or cyber war, economic war, or deteriorating wealth conditions, 10 years back was not easy. So it's a printed material. This is what I call the strength of predictive analytics, that you can foresee what is coming, but you have to adapt and track data on daily basis. How is changing? If anything is changing, we have to change our mindset, change our portfolio. This is a larger picture how Indian asset classes from 2020 till 2030, we say this is the era of value investing, emerging market, Asia-centric emerging market, India in particularly. This is one of the reasons we talked about value as a thesis. So we said in 2019 that this decade belongs to value, and in November 2021, when we spotted in euphoria in global equities and the growth stock, we launched our Quant Value Fund, which is one of the best performing fund in the category. That is the importance of timing. Again, if you can time it better, it is our endeavor to do that. So very quickly, I talk about few things. Time is very limited. Okay. Look at the performance when we talk about dynamic style of money management, the risk mitigation techniques. Okay. This is NAV till day for yesterday updated picture. How industry in last 1 year has not, the indices or benchmark have flat, but our schemes have made 5 times high NAV. Okay. That's important. That market has not gone on where NAVs had made 5 or 6 times all-time high. And look at the gaps between the benchmark and our performance. And it's not only one scheme we are trying to demonstrate. Across all the categories, we have been leader. Small cap, the market has not made a new high in the small cap. Therefore, yesterday we are close to all-time high. We recovered largely the fall which happened in the market a week back. So is the text plan. Look at the gaps. So is the mid cap. Similarly, in absolute fund, our flexi cap fund, infrastructure. The very interesting data, the infrastructure fund at the peak of technology cycle has outperformed the technology funds. So it's a strength how dynamically you manage even infra fund. The gaps in the infra index is substantial. Value fund, this is a fund which I talked about. Okay, large and mid. Multi-asset fund. This is another thing, since Naren talked about multi-asset thing, I think it's a great opportunity what he's saying. Because if there is uncertainty about the market, multi-asset, we also manage the schemes in a very dynamic manner, where we can go up to 80% gold or silver or commodities. We can go up to 80% equity. We can raise 80% up to 80% cash. It is a far, far superior product, okay, in the environment. Personally, if you ask me, which will be a flagship product in 10 years' time, so it will be multi-asset, okay? Because this is the product which we believe gives you huge opportunity switching between asset classes. It reduces your risk in a big way and has the highest flexibility apart from our flexi, which has the another important equally flexible. Quantamental, if you notice, is a quant fund. As of day for yesterday, it made a lifetime high where market has not made. Okay, so NAV is lifetime high. Focus fund, a large cap fund, also delivered extraordinary returns. Okay, so is the ESG. Okay, let me now talk about, a lot of people are looking to us. What is the outlook for 2023? I'm just trying to give you a glimpses, this is which we covered in our monthly conference call. If you guys don't attend, at least every mid of the month we do, and we talk about a global perspective, what is changing. Now I'm going to talk about what is narrative versus what is data analytics. Okay, narrative is all messy picture, extremely pessimistic environment, tightening continues, all sort of interest rate rising inflation, all worrisome picture. Best of the analysts have downgraded. In September 2021, they were all very gung-ho about the market. As market fell after 30%, everybody realized something has changed. That is the narrative which we talk about, how prices change your perception and then the write-up comes. Okay? We talk about how a predictive analytics model are showing the global tightening cycle has peaked out. This is not a contrarian call. It's a data-driven call. The globally tightening, which started somewhere in February 2022, actually has peaked out, which means easing phase has started, and China is the first market which started easing. As you all know, China has already rallied more than 30% in last month or so. So macro parameter of the economic high frequency data in China improved a lot, and China is the first market to move up. Against the consensus, tightening continues. No, tightening cycle has peaked out. Easing are still in the early stages. So liquidity has started improving globally, but still in the very early stages. Very interesting data. Global risk appetite has started improving, which peaked out in the financial year or the calendar year 2021 for various markets started inching up, which means if the liquidity is rising, risk appetite is improving, which means the P multiple of global equity and asset class will also improve. If you ask me, this was the question asked one of the media, if you compare as we entered 2022, what I said 2021, it was much worse picture. It was ugly picture. As we saw in December 2022, for 2023 outlook, data points are much more constructive as compared to what is the global outlook. This is, I'm talking about pure data. Yes, 2023 will be equally volatile. We talked about how 2017 till 18 till 2023 will be very, very volatile phase. And this is something which I'm talking about. Best of the analysts are negative. Valuations are reasonably attractive. Positionings are very wide. Leverage positions are not there. So market is actually geared up for the probability, if you ask me, is much more on the upside than the downside. Anyway, how we manage money, we don't marry with this view also. This is the background of macro data which we keep in mind. What we look at, value as a thesis will continue. Okay, beaten, neglected down names continue. So we continue to believe that India is a great structural story, both on relative basis and absolute basis. India, this decade belongs to India. I'll take one step, half century belongs to India. That's a manufacturing cycle is playing out. And if all of you play this cycle right, lot of retail and investor will going to make big money. 2023 is volatile. That is the last leg of the volatility cycle. So you have to keep in mind, don't get fearful when there's a capitulative move. Don't get too excited when there's a euphoria. So we do the reverse. When we see complacency in the market, we prune down our exposure. When we see panic in the market, we are buyers in the market because the buy on dip strategy continues. So we continues to like PSU banks as a thesis, capital good, industrial, anything which revolves around manufacturing. So manufacturing is a larger bet, infra as a cycle. So we continues to believe that this thesis continues. Let me also give you one interesting example. Every bull market has a leadership. 2003, it was the FIs who were on the driving seat. They took advantage until December 2007 or October 2007. They made tons of money. They were leader in that phase. Come August 2012, it was the Ultra HNI family office. They was on the driver's seat and they big money till December 2017. April 2020 onwards, the retail is on a driving seat. Okay? And the base of retail is very high, very, very large. And our thesis says that this decade belongs to retail, which means this decade belongs to you and me also. As a manufacturer or as a distributor, provided we get it right, okay, provided we able to guide our investor properly. So this decade is a phenomenal wealth creating opportunity. 2023 will be challenging, more from the volatility perspective, okay. I always say, make this invisible animal called volatility as your best friend so that you are not scared of. So when cycle is on your right side, you should play it. If you make this friend your best friend, then you're able to monetize. This is a psychological game, how well you play it. So sector rotation is also a thesis which we talked about, which will do very well. So last slide I will take down. As a ITC case study, I will just pinpoint few data points. So I think some of the data points, some of the colleagues were there yesterday, I briefly talked about. When we talk about VLRT framework, what goes into one-third weightage, valuation analytics. What goes into valuation analytics is the cash flow indicator, financial ratio, both in absolute and relative basis. What goes into liquidity, the smart money flow analysis, holding pattern, indices management, sector rotation, that's what it goes. And what goes into risk appetite, which is sentiments about euphoria, capitulation, okay, or you talk about fear and greed indicator. This can be both domestic as well macro. So one-third weightage. On this basis, we spotted that ITC in September 2020 was on the lower side. So we all talk about 80-20 as a thesis that 20% returns give you 80% return. 20% stock gives you 80% returns. I will take this concept to the next level. I say that 20% time stock gives you 80% return. If you miss those opportunity, those are the inflection points. And this what we spotted in September 2021 or December, that the fourth quarter of 21, the ITC perception analytics was negative. The fear index was the lifetime high, and stock was trading in the most neglected, or what we call it behavioral, most hated zone. Reverse was true for the technology stock, not only India, globally. So all technology stock, the perception was lifetime high. They were all trading in the complacency zone, okay? And the greed element was extraordinary. And so banking sector was somewhere in between. It was not on the extreme on either side. They were more close to the neglect territory. And that's the reason we brought ITC in our portfolio, banking in our portfolio, and rest is history, how well technology stock. So we are not negative about technology as a sector. I'm just trying to highlight at that moment it was looking ugly. If time permits and they hit a lower or reach a most neglected zone, we'll take advantage. The whole thesis of dynamic style of money management is all about how much variable which is available in the market, how well you can capture. It's only possible if you can capture through technology, through process. So we are very process oriented. We quantify lot of data points in normal environment, and we use these things in difficult times. When market is collapsing, that's the time you don't have mindset to analyze something new. If you have built something which has historical track record, I'm not talking about India for 20 years data. We'll talk about, I have done back testing that has no relevance, because you have to look at 100 years, 200 year, 300 year cycle, what is available in the gold. Look at the wheat, it has from 1200. So we look at a lot of cycles. How on what basis we said in 2012 that 2020 meltdown will happen, okay? We were not superficial or superpower to predict that. It was multiple cycles was coinciding. The magnetic field was changing. We moved from the North Pole, moved from Canada to Siberia, and we talked about how Russia will re-emerge. So this is how all mass adds up and it moves up. Thank you very much.
Thank you, Mr. Tandon. And yes, timing is everything for you. Good.
Yeah.
Thank you so much. May I invite on stage Mr. Tejas and Mr. Deepak Chabria to kindly give a memento to Mr. Sandeep Tandon. Yeah. Please do stand in the middle.